Welcome everyone. Today we are going to talk about S of SRP, and that S means structure. And when I talk about structure, I'm talking about market structure. Market structure. So today we are going to look at understanding market structure. What is market structure? The second thing we are going to look at is long-term market structure and immediate market structure, because there are two types of market structure: long-term market structure, immediate market structure. And then the next thing is how to discover directional bias on higher time frame. And then the last one is what I need to see on the higher time frame, what a trader needs to see on the higher time frame that will make that person to start looking for entries on the lower time frame, and why trading against structure very, very, is a very an error that a trader should not make. So let me share my screen so that we get started. Um, right. So market structure. When I started this, I was like, how do I do this? It's a way that someone that do not know anything about trading, the person will be able to understand it. But this is how I'm going to start. Before any trader that lost, someone that has been having losses, before any trader that have been having losses, um, before they try to find out why that losses is going on, there's a question that they have not answered. There is a question that they need to answer. And that question is, who is in control of the market? Some, traders, someone that has been having consistent losses, there's something that they are missing. There's a question that they have not asked themselves: who is in control of the market? Who is in control of the market? Because at every point in time, you know, somebody is in control of the market. And so if you are looking at the screen, you will see green candles, you will see red candles. These things they are not just charts. These things are actually, buyers and sellers. This is like a war between buyers and sellers. And any time that you see a series of green candles dominate, it means that buyers are in control of the market. And then when you see series of red candles dominate, it means that sellers are in control of the market. But what every trader, the market structure, this is also like your, any market in your village or in your town. It's just that this one is the global market. It's the global market where people trade currencies. People trade currencies, commodities, people, make money in the global financial market. We now live in a globalized world where we connect with each other, we do business with each other, we make money, from wherever we are. And that is one of the best, one of the things that I like about forex trading. When you have this skill, wherever you are, if you have electricity, if you have the internet, you can make a lot of money for yourself. If you have, say, you plug into the global financial system and you make your money. Nobody will bother you, right? Nobody will bother you. So what buyers and sellers are looking for is to, first of all, buyers want to buy at cheaper prices. Buyers want to buy at cheaper prices, and sellers want to sell at higher prices. So buyers want to buy, they want to buy when that thing is cheap. It's just like your normal market. When you want to buy something, you buy it when it is cheap. And then when whatever you bought when it is cheap, when you have made profit, when it is expensive, you have made profit, you sell, and then you collect profit. So sellers sell, they sell it when it is high, when it is at a supply zone, when it is expensive. That is when sellers sell, eventually sell. So sellers want to sell when, that is at a supply zone, that which is when it is expensive. All right, when it is at a premium zone. And then buyers want to buy at a discount zone. Discount zone means when it is cheap. All right, when it is cheap. So that is, kind of a summary of what is really going on in the market. All right, so the market is a battle between buyers and sellers. When buyers are winning, then it is bullish. It becomes bullish. And when sellers are winning, it becomes bearish. When buyers are winning, it becomes bullish. When sellers are winning, it becomes bearish because of the way these two animals behave. A bull, lowers himself, lowers his head to be able to attack, and the bear pounces from, kind of pounces from, from the above, kind of, puts his head, at the top, and then probably attacks and drags the person down. So buyers, when buyers are in charge of the market, they are called the bulls. The bulls are in charge. It is bullish. And when sellers are in charge, they are called the bears. Market is bearish. But how does price actually moves? How does price? Before we talk about, okay, so let's talk about how price actually moves. So before, um Adivai, can you hear me? Can you still hear my voice?
Yes, yes, I can hear you. I
Awesome,
can hear
awesome,
you.
awesome. So this is a diagram that I drew, and I'm going to draw it again. Before buyers actually take control of the market, they have to remove the sellers. Before buyers take control of the market, they have to remove the sellers. So first of all, before a buy will happen, a sell must happen first. Before a buy will happen, a sell will happen to clear out the lows. So after clearing out that low, so you now have that is higher high, that this is higher low. Then you now have the next higher high. So and that higher high must be higher than the previous higher high. And then once this has happened, this that resistance has been taken out. Then you have the new higher low. The new higher low must not be lower than the previous higher low. So it will just continue like this. This shows you that buyers are in charge. This is like a bullish trend. You have the new higher high, then you have the new higher low, you have the new higher high, you have the new higher low, you have the new higher high, you have the new higher low. So this is a bullish trend. This is a bullish trend. All right. So let's look at bearish trend when sellers are in control. So and this bullish trend, you could see something like that here. Um, trying to You could see it on the chart. You could see it on the chart. You could see, let me mark it. So you could see higher low, higher high, higher low. And then the next one it must be higher than the previous higher high. Then you have this higher low. And then the next high must be higher than the previous higher high. And that was that was when sellers took control of the market from them, and then and then it sold. All right. So let's talk about the sellers. Before a sell must happen, a buy must happen to clear the highs. Before a sell happens, a buy must happen to clear out the highs. That's what people that talk about market structure don't really talk about. Like I said before, before buyers take control of the market, a sell must happen to clear out the lows. It cleared out the lows, and then it took out the high, confirming the market is buying, and it came to this discount zone. This is like a zone, because people want to buy at a cheaper price. And then so you are not having, so the next you're not having higher low. The next higher high must be higher than this. That shows you that the market is in a bullish trend. It was higher than the previous higher high. The next higher low must be lower, must not be lower than the previous higher low. So everything is just market is just going up, going up, going up until it gets to the climax, and then sellers take control. Now, I like this. So before sellers take control of the market, something happens. Before sellers take control of the market will have to first of all buy, and then you have the sellers take out that low, right? They take out the low, and so this is higher, lower low, then lower high. It must not be higher than the previous high, and then the next low must be lower than the previous than the previous lower lower low. So lower low, lower high, lower low, lower high. lower low, lower high, lower low, lower high. And this shows you that this is a bearish trend. Market is trending. So even as is doing like this, it's actually going lower and lower and lower. All right, it's going lower and lower and lower. However, people that talk about market structure, they tell you about higher high, higher low, higher high, higher low, higher high. Then that is for buys. Then they tell you about lower high, lower low, lower high, lower low. That is for sell. And you think that is how the market moves. No, the market does not really move like this. So that you don't just enter a trade, probably like this and at anywhere, and then you want to make profit. Market, yeah, this is higher high, higher low, but the market does not really move like this. So let me show you exactly how market moves when it comes to the buys. When it comes to buys, this is how market moves. So let me remove this. I drew it here, but I will draw it again. So first of all, buyers want to take out the sellers. So now the sellers have been taken out. The next thing you see is that the buyers take out their resistance. So this resistance is a break of structure. You can call it a break of structure, and in SRP, it goes beyond being a break of structure to becoming that resistance becomes support. And we are going to talk more about it. So it takes out the high, and what happens? Sometimes this happens. First of all, market will come to the equilibrium and then do as if it's buying from there. Sometimes it may break structure, sometimes it may not. And then market will come to the discount zone. And then that is where the main buy will happen. So this is this is a break of structure. This is like a major break of structure. The first time it happens is a market structure shift. It shows that buyers have taken control of the market from sellers, and buyers are in control of the market. And then going further in SRP, we call it RBS. All right, we call it RBS. It means resistance becomes support. It means that this resistance has been taken out, and so the low of that resistance is now a support zone. Is a zone that buyers, you should enter your trade from. This is where you take your trade from. So market will go up, and then it comes to this 50%, and create a buy key level and all of that, and buyers will rush in to buy. But this is just equilibrium. This is where you have inducement liquidity. This is where market traps traders, because it will just buy small and then it will sweep and take it out. It will sweep this low, and then it will come to the discount zone. So how do we know the discount zone? How do we know the premium zone? Use a tool called the Fibonacci retracement. So once this full range has been formed, we just mark from the low to the high. This is the high. So you could see that after market did that market structure shift came to 0.5, which is the equilibrium, and then he tried to buy from there, and then he later swept it, came to the discount zone. In SRP, this is like type 2 of SRP, and we're going to talk about that. He came to discount zone. So you want to buy when price is cheap. All right, you don't want to buy at a very high zone, because you want to put your SL here below this low. So you want to buy when price is cheap. So if you enter your buy here with your confirmation, you target this high, right? And when this happens, this is when the break of structure has happened. This one is market structure shift. Buyers have taken control of the market from sellers, and is also RBS, and meaning that this resistance, this space has become a support zone. And then once market breaks out this high, it becomes a break. It becomes a break of structure. Right? This space becomes a break of structure, major break of structure, especially if it is on the higher time frame, 4 hours and above. So this is how the market moves, and also an RBS as well, because market will go pull back again the way it moves, and it pull back to another discount zone in this zone, and then buy from there. So for buy, this is how market moves. It's not like it just keeps going up, going up like that. No, 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 no. You wait, you wait for market to come down to the previous discount zone, and you buy from there. And this price is also called a bullish order block. Why is it called a bullish order block? That is where the buy started from. And the low that created the high, market always comes back to that low that created the high. That low that created the high is a bullish order block, especially if it broke structure. When it broke structure, and it created an inducement liquidity, and it cleared that inducement, so or engineered a liquidity, it is valid. All right. When market comes there, it has become a strong support. All right, especially on the higher time frame. When market comes there, market buys from there. So this is a bullish order block. This is a major support zone, and this is where so when all of these things are happening, you don't panic. You don't say price has left you. You wait for price to come to this zone, to this discount zone, and this is where you buy from. This is where you buy from. This is market. This is the way market works. This is like the market structure. Like I said before, buyers control the market. A sale will happen that will clear the sale will happen that will clear the low. Then you have that market structure shift, which is also RBS, which we also call RBS. And then once it happens, the next sometimes price will come, almost all the time. Price comes to buy from this equilibrium. This is the medium, the 0.5, of the range. If you market with Fibonacci, you don't buy from there. You wait for price to sweep it as liquidity, which means that price. So this will be like your IDM, and the IDM is called inducement liquidity. This is a trap market set for you. It's liquidity, a trap market set for you. And market needs this liquidity so that it can move. Market needs money to move. Liquidity is money. And market needs money to move from one place to another. So it will create that trap so that people will enter early. All right. Buyers will enter early, and then market will sweep them and use their money to now make that move, where it will now, get to this high. So this is how, this is like a typical market structure for buy, and how you enter the market, how you buy. So what about sell? So like I said, before a sell happens, a buy must happen. So buyers are in control of the market, and what happened? Buyers are in control of the market, and then sellers took control and broke this low. All right, sellers took control and broke this low, and then here price comes to the medium equilibrium and tries to sell. Sometimes it breaks structure, sometimes it doesn't. Okay, let's say it breaks structure, but this is not where you sell from. You want to sell from the premium zone. So let me explain what happened here. So market was buying, and then you have that a massive sell that happened, and it does market structure shift. All right, you can call it MSS, but then so this is a market structure shift, and then in SRP we also call it SBR, right? We call it SBR. What it means is support becomes resistance. It means that market has broken this support zone, and so this high becomes a resistance zone. So it means that sellers have taken control of the market from buyers, right? Sellers have taken control of the market from buyers. This, right? And so if you want to sell something, you sell when that thing. If you buy something when it is cheap, you sell it when it is expensive, so that you make money. All right. If you buy something when it is $10, you sell when it is $50, you make profit. You sell when it is $100, you make profit. So when that price has gone to the top, you sell. So you sell. So the same thing happens in the market. You sell you don't sell here. No, this is a discount zone. You sell when it is the premium zone. When the range has finished forming, So this is the premium zone. This is where you sell. All right. This was when it was confirmed that this market, that sellers are in control of the market. All right. This was when sellers broke this low and with the body of a candle, and it was confirmed that they were in control of the market. So you wait, and this place is also a bearish order block. This is where the sell started. All right, this is the high that created the low, and so you wait for that for market to come to that zone. That is where you take your sell. And in SRP, you have type 1, type 2, type 3 because it must not come exactly to this zone. There are different zones it comes to, based on your Fibonacci. So you use your Fibonacci to mark the range. All right. So this was a full range. It was a full range before market then, went back, pulled back in and all that. And you could see after market has done this, it came to this zone, right? It came to this zone and it tried to, okay, let's use this. It came to this zone 0.5 and it tried to sell, So sellers who were early, market will use them as liquidity, right? Sellers who were early, market will use them as liquidity. So market will use them because market needs that liquidity. Liquidity is money. Market needs that money, that liquidity, so that it could go up. It could go to the next direction. So that's why you don't enter at 0.5. You don't enter at that 0.5 of the range. You don't enter at this range, this 0.5 of the range, right? You don't enter at that. You do not enter at that range. Let me just, so this is actually the, okay. Okay, this is the full range. So you don't enter, you wait for market to. So from 0.68, yeah, from 0.618 to 1 is the premium zone. From 0.618 to 1 is the premium zone. The same thing if you are marking for buy. This is for buy. If you are marking for buy, this is the high. You still mark it so that so you can see the 0.5 is IDM, inducement liquidity. So from 0.618 to 1 is your discount zone. If you flip it to the other side, that's it. It's your discount. So it's only when price enters at this, for buy, it's only when price. First of all, what do you need to see on the higher time frame before you start looking for entry on the lower time frame? You need to see on if it is for buy. First of all, you need to see this RBS. It needs to happen. Price needs to take out a major resistance. And if that trend, if it is a bearish trend, the first time it happens, it becomes a market structure shift. All right. Sellers have taken control. So if it is for if it is for okay, let's talk about if it is for buy, you need to see this. You need to see buyers take control of the market. All right. You want to see a break of structure happen or a market structure shift, an RBS, especially on the 4-hour time frame, and then you want to now avoid that inducement liquidity. You want market to clear liquidity because if market has not clear liquidity, then you are the liquidity. You want market to clear liquidity and then come to the discount zone. That discount zone, that is where you go to the lower time frame and you get your confirmation. We're going to talk about that. Use your confirmation to enter. All right. So first of all, market needs to do this. It needs to, do RBS on 4 hours, and then it needs to clear liquidity, and then it needs to come to the discount zone, and from the discount zone, then that is where a buy will happen. And we're going to look at it on the chart. Then for the sell, what do you need to see before you enter a sell? You want sellers to take control of the market from buyers. So SBL needs to happen, right? Which is also if the market is bullish, then when it happens, is also a market structure shift, a bearish market structure shift. And then so you want it to happen, and then you want market to clear liquidity and come to the premium zone. And the premium zone market will give you your confirmation, and then that is where you sell. So you only sell from premium zone and you only buy from the discount zone. All right. So that is the way the market works. So when market breaks for buy, when market breaks above this zone, you don't rush and buy here. No, you wait for market to come to the discount zone, which means you need to know mark your range. And that's why SRP means structure, range, POI. Today we're talking about structure. All right. Same thing with here. When market breaks below this low, don't just rush in to sell. You need to wait for market to come to the premium zone before you sell, right? So now there are two types of market structure. All right, there are two types of market structure. You have the long-term market structure and then the immediate market structure. The long-term market structure is for a particular pair is what is the dominant narrative of this pair? What's the dominant bias of this pair? Where is this pair heading to? Where is this pair on the year time frame, 6 months time frame, monthly time frame? What is the directional bias of this pair? Is it bullish or bearish? Long term, we're talking about years, months. For example, gold, the long term, market, market structure, directional bias for gold is bullish. Gold is all-time bullish. So any buy, any sell is just a pullback. Any sell is just a pullback. All right. Gold is all-time bullish. It has been bullish for years, thousands of years. All right. So it means that the price of gold will keep going up because even the global currencies are losing value. Global currencies are losing value. All right. So that is the long-term market structure. All right. So and the long-term market structure, you should see it on the monthly time frame, 3 months time frame, 6 months time frame, the yearly time frame. Then the second type of market structure is the immediate market structure. The immediate market structure is the short-term story of the market. What the market is telling you now, that's the one that if you want to enter a trade today or this week, you want to know the immediate market structure. Market may be long-term bullish and short-term bearish. Market may be long-term bearish and short-term bullish. So you need to know the immediate, structure of the market. And how do you know that the time frame that we enable you to know that this is 4 hour time frame and the daily time frame, the 4 hour time frame, the daily time frame, and also sometimes the weekly time frame. All right, the 4 hour time frame and the daily time frame helps you to know the immediate structure of the market. They help you to know the immediate structure of the market. So uh, let's take a look at this particular price. This is JP225. Let's go to the 6 months time frame. So this particular pair, if you look at this, you will see that this pair is long term bullish. All right, let me remove all of these things. So this market, this JP225 is an index, is an indices, an index pair. It is long-term bullish. Already on the 6 months time frame, you could see it's been buying and buying and buying. Since it started, this is 2001, this is 2000. It just did a little bit of sell and then it's been buying and buying and buying. It's long-term bullish because of course it represents top 225 companies in Japan. And Japan is one of the top countries on earth. On earth, it's long-term bullish. If I go to 3 months time frame, it's the same thing. If I go to the monthly time frame, it's the same thing. Right? If I go to the monthly time frame, it's the same thing. It is long-term bullish. But the question is it currently bullish? No, it's not currently bullish. All right. So if I want to check the immediate structure of this, I will have to go to the 4 hour and the daily. So let me come to the daily time frame. So if you come to the daily time frame, you will see that this market was doing. So how do you now know that the structure has changed? So let's talk about when we're talking about higher low, higher high. So you could see higher low. Okay, let me mark this. So higher low, higher high, higher low, the next high, the higher, so this higher high. Then you have higher low, and then you have a higher high. Now it was supposed to pull back, the next low must not be lower than this. It was supposed to keep going up. But what happened? So you have this higher low. So it took out that low. Sellers took out that low. And since then, it's been selling on the lower time frame. Since then, it's been selling on the lower time frame. So this market is long-term bullish, but short-term bearish. short-term bearish. This resistance has not been broken. This resistance has not been broken. So let's go to 4 hours time frame so that I will show you what you need to see. The SBR RBS that I mentioned both for bullish and bearish. Let me use Euro USD for this. Euro USD. All right. So this market, first of all, this market. So let's look at the long-term structure of this market. Let's look at the long-term structure of this market. So what's the long-term structure of this market? So this is the 6 months time frame. You could see that the long-term structure is bullish. This market is bullish. It's bullish long term. Since then, it's been reacting at this level. All right. Let me remove all of this. All right. So it started. This was in 2002, and it went to this high. Went to this high. And since then is long term is still looking bullish long term. But since then, after making this high, it's been it has not been able to break above this. It has not been able to break above this. So it has already created a high, right? But it has already created a high long term. But then again, even on that long term, something has happened. This is why it has not really been buying. This is 6 months time frame. It broke this low. Market broke this low, and since then it's been facing resistance here. It's been facing resistance here. Then if we come to the monthly time frame, so this is what we have on the monthly time frame. This is also long term. The monthly time frame is looking bullish because it broke above this resistance and it will come to this zone and then buy from there. All right. So it's bullish, but for it to come to this zone, this is monthly time frame. It means that each candle takes 1 month to form. As is for it to come down to this zone, it will sell massively on the lower time frame, making it bearish for some time. Probably even for a whole year. It could be bearish for a whole year. But all it's doing is just to come to this zone and pick order and then buy. And probably when it buys, it may break this resistance. Right? So right now, even on the monthly time frame, it is bearish. All right. Right now, it is going to sell to this buy zone and then buy from there. Even though it has broken above this, it's going to sell and then buy from there. All right. So to know the immediate structure of this market, if we come to the daily time frame, we know the immediate structure. What's the immediate structure? So you can see what it was doing here. So you have higher low, higher high, higher low, higher high, higher low. Then you have higher high. And then after creating this high, okay, it created this higher low. And the next high was not higher than the previous high. So this is called failure swing. Market is losing momentum. But this particular low is still protected. This low is still protected. But then what the market do? It broke this low, this higher low, and that is the first sign that this market is bearish. And then, as though that is not enough, it broke this low too, making this market bearish. Right, market bearish, and now it's been selling on the lower time frame. It's been selling on the lower time frame. So let's go to 4 hours. 4 hour is the tradable time frame. If you want to know the immediate bias, you use 4 hours and you use daily time frame to know the immediate bias of the market. If you want to know the long-term bias of the market, you go to the weekly time frame, you go to the monthly time frame, 3 months time frame, 6 months time frame, and the yearly, the 12 months time frame, the yearly time frame to know the long-term bias of the market. On 4 hour too, you will see, you know, that this market was buying at a point, and then it started breaking lows. All right, it started breaking lows, creating lower lows. When markets start creating lower lows, it is bearish. All right, it is bearish. So, but I want to show you what you need to see on the on the higher time frame before you take a trade on the lower time frame. And this was a trade that we called. We called this particular trade. So you will see market came here and broke this low. So let's mark this. So by breaking this low, this is SBR, right? This is SBR. Market broke this low. This is SBR. It's also a break of structure, a bearish break of structure, because already this market is already in a bearish trend. It's already in a bearish trend. So it came here, it created this setup and then broke all the lows here. Broke all the lows here. So, and what it means is that the high that created that low has become a resistance. So support becomes resistance. So this top, this high has become resistance. All right, it has become resistance, and so you need confirmation on the lower time frame. So instead of like just like we marked on the Fibonacci. So let me mark the range. If you want to know the full range of this, so this is the high and this is the low. So let me move this and show you what I showed you before. This is the high and this is the low. And I told you that sometimes market will want to buy from the zero, market will want to react from that 0.5. You can see at that 0.5, you see where it kind of reacted around here, and even all the way here. Some people try to sell early at this zone, but market went and used them as liquidity. So market swept liquidity. So let me remove this. So you will see that market swept liquidity here. So if I mark this is inducement liquidity, because market needed that liquidity to be able to make the next move. So when this happens, you want to sell from the top, you want to sell from the premium zone. And since market has formed this full range here, the premium zone is here. This is where you sell from. So it happened when once market has broken the low, you don't sell from here. This is the discount zone of this market. You want to sell when price is high, when price is expensive, where you can make profit, and you sell at this high, at this high. So, and as long as market did not close above this range with the bottom of a candle, it is still bearish. So that is why you need that lower time frame confirmation. So when market came here, we're going to, when we talk about point of interest, we'll go down to lower time frame and we'll see what market did. But even on the 4 hours, you can see that it did the bearish equity grab. First of all, it did this sweep, and after doing this sweep, it broke below the lows here. It broke below the lows here. You can see that. Which is also like another SBR, and then it picked order here. It came back and picked order. So you just sell it, in SRP, you sell, your target is here. And you can see when market hit that target. Your objective target is here. You can also come out at 1:1, 1:2. We are going to talk about risk to reward and all of that. But this is the final objective target. All right. If market goes beyond that, that is a bonus, but this is the final objective target. That's the low it created, and it broke it because this market is bearish, so it keeps breaking lower lows. A bearish market will keep breaking lower lows, and a bullish market will keep breaking um highs. All right. So it created another setup that it came here to pick up, and then it sold from there. So you will see this market has been selling. When it comes to the premium zone, it sells. It even came back here again after breaking this low. It came back to this zone and then it sold. All right. So when I see this on the higher time frame, I wait for market to come back to this zone, and then I go for the lower time frame where I get my confirmation. We get our confirmation, and that is where we sell. So first of all, I need to see this. I need to see this. I want market to create this setup and then break the lows, confirming that market is bearish, right? Even because when this thing was happening, when market was buying to this zone, the lower time frame, it was bullish, a bullish movement inside the higher time frame bearish channel, bearish structure. And so you want the lower time frame to align with what the higher time frame is saying. Market on the higher time frame is bearish. On the lower time frame, it was bullish because it was buying to a sell zone. So you only sell when the lower time frame eventually begins to obey the higher time frame by aligning with the higher time frame. And the lower time frame takes price to the direction, to the target of the higher time frame. So when market breaks these lows and gives us this SBR, which is a breakout structure, all right, which is also a breakout structure, making this zone is a resistance zone. I then go to lower time frame and then I look for entry. All right, and then I've seen that it has clear liquidity. And I start looking for entry. So what about the buy? What do I need to see for buy before I enter a trade? So let's go to when this market was bullish. You can see when this market was bullish. All right, so this was when this market was bullish. Let me use another USD. Okay. Hmm. USD 4 hours. All right. Yes, we're there. Amazing. So like this. So what do I need to see? And and what we're talking about when market is bullish, when buyers are in control of the market. At this time, EU was buying, it was bullish, and you could see that it was breaking the highs. It was breaking the highs. So let me use. You could see a lot of setups here. But let me use this one. So here market broke this massive pump that happened. Market broke the resistance here, right? Market broke the resistance here, and this is a break of structure because the market is already bullish. So it's a break of structure, is also an RBS. So RBS, what it means is that this resistance zone, market has turned it into a support. But the support is not here. The support is in the low that created the high. If it is about resistance becomes support, then the resistance is in the high that created the low for sell, for sell. But if it is for buy, so here that market has done RBS, the support is at this zone, the low that created the high. But how do you now know? And I said when I was talking about market structure, you buy from the discount zone, you sell from the premium zone. You want to buy when prices are cheap. Alright, so what you do is that you mark the range using your Fibonacci tool. So this is the low of the range, and this is the high of the range. Right? This is the low of the range, this is the high of the range. You mark your range. The next thing you do is you wait for market to come to the discount zone. You also want the market to clear liquidity. Sometimes, it does it at 0.5, but if it doesn't do it at 0.5, it may do it at a much lower. Market does not move until it has clear liquidity because market needs liquidity to move. And you could see, so let me remove this. You could see what this market did here. This was where it cleared liquidity. Use these lows as if it intentionally created this low as if it was buying, and then it used the lows as liquidity. And this is also inside the discount zone. That's why we have different types of SRP because sometimes even at 0.618, market may create lows there and use that low as liquidity and do 100% retracement. So this is inducement liquidity. This is, let me just call it liquidity. And when market clears liquidity, shows you that this market is now about to make the real move. The real move. So, and then it must not break that low with the body of a candle on the higher time frame. It must not break that low. So you could see that this market did 100% retracement, and this was instead of breaking this low with the body of a candle, it swept it. So this one did 100% retracement after confirming buyer. This was when it confirmed buyer. So the reason why many traders lose money is that when market confirms buy and breaks the resistance, they want to enter there. You don't enter here. And you can see what this market did after it broke that resistance. It created a small buy order here. You can see these buy orders. You can see candles that try to buy from here, but then you have a massive red candle that then swept all of them. So all the traders that try to buy from this zone, they hit SL. You don't buy from a premium zone. Where will you put your SL? You are supposed to put your SL at the low of the power range. It means that the person will be risking a lot of money. Money will not even if they they will be risking a lot of money to be able to put their SL here. But why well if you are patient enough and you wait for market to come to this discount zone, you enter here, your SL is just here because your SL must be at below the range, the 4 hour range. That is why 90% of trading is waiting. Waiting until market gives you exactly what you're looking for. Waiting until market gives you your setup. So when market does this, you wait for market to come to the and what is the discount zone? I mentioned that premium zone is from 0.6 to 1, 0.618. The same thing with discount zone. So if you mark the range, basically you can use your triangle to mark all of these zones from here to here is your discount zone. That's why you need confirmation. If you enter aggressively here, you can see that price letter swept. So that is why you need that lower time frame confirmation. So when market comes to the discount zone, you go down to the lower time frame, like 1 hour, 30 minutes, or 15 minutes, and you look for confirmation, and that is where you enter from. But this is the discount zone, and this is the equilibrium. This is the premium zone. In a buy trade, you enter from the discount zone. All right, you enter from the discount zone. Alright, so and what is the objective target? The objective target, the final objective target is here. It's high. And it took some days before this market got to that. You also have the first objective target, which is here, 50% of the range. Alright, you can also use RR. There's risk to reward, 1:1, 1:2, and when market gives you 1:1 or 1:2, you can come out. All right, but so this is the final objective target. This didn't happen. Market picked you on 27th of August and it delivered to that target on 5th of September, just like a week or so. All right, it got to that target on 5th of September and it's everywhere here. You can see market breaking this high and then picking order here, you know. All right, so and then it created this final high and then sellers to control this low and all of that. So that is the market structure. That is, how buys look like on the chart and how, how a buy SRP setup look like on the chart and how a sell SRP setup looks like also on the chart. So what are, there are 4 conditions when what you must see on the higher time frame before you go into lower time frame. There are 4 things that must happen, 4 conditions, things you need to consider, before you say that you are trading with structure because you want to align yourself with structure. You don't trade against structure. Trading against structure. First, if market is bullish and you want to sell, it may work against you. The same may be happening on 15 minutes or 5 minutes, but that is inside a high time frame bullish structure. And market is, why you should not sell inside a bullish market is because market breaks highs. And so market may come for your stop loss. That market is buying and you are selling. It does not align. So you want to be in alignment. And if you want to trade correctly with structure, the 4 things that the 4 conditions you must meet. Number 1 is clear direction. A clear directional pattern of highs and lows. The highs and lows, it should be clear. It should not be sideways. Yes, you have a bullish market. This is when buyers are in control. Then you have a bearish market. This is where sellers are in control. And then you have a ranging market, a sideways market. Nobody is in control. You don't want to be in that kind of market. You want, if it is for buy, it needs to be clear that market is creating higher highs and higher lows. If it is for sell, it needs to be clear that market is creating lower highs and lower lows. Clear, clear pattern, clear directional pattern of higher highs and higher lows. All right. If market is buying, the new high must be higher than the previous high, the previous higher low. If it is for sell, the low must be lower than the previous lows. The second condition is a confirmed break of structure. A confirmed break of structure. Market needs to break structure. That's why you use 4 hours to confirm it. If it is a bearish market and then market goes below on 4 hours, that is a market structure shift. So the first time it happens is a market structure shift. The second time is a break of structure. So you need to see that needs to happen. For example, this market was buying, and then it did this sweep. And when it broke this low, this is a bearish market structure shift. It shows that market has changed. The structure has changed to bearish. And then you can see it picked up that here. And then when it broke this is a break of structure. The second time, so market has already, sellers has entered the market, and then from that market, bearish market structure shift. The next thing we are seeing is a break of structure, a bearish break of structure. This is when market finally confirmed. This is now market saying that it's bearish. Right, the trend continues, the bearish trend continues. And what happened? It just kept selling. So lows are being broken, you know, lows are being broken, every sell is a pullback, every sell is a pullback until it got to this low, All right. So you want a confirmed break of structure. And the third one is you want a confirmed RBS or SBR on file. You want a confirmed RBS or SBR. For example, if it is for buy, you want market to break above and give you a confirmed RBS on 4 hour time frame. And then you wait for price to come to the discount zone, and then you enter enter the buy. If it is for sell, you want market to break the lows and give you a confirmed RB. If it is for buy, you want market to break the highs and give you a confirmed RBS. That is, resistance becomes structure. Resistance becomes support. If it is for sell, you want market to break the lows and give you SBR on 4 hour time frame. All right, you could see this. This is for sell. Market broke these lows, and this is SBR. And then you wait for market to. This was where I calculate. You wait for. This is the full range. That's why patience is needed in trading. This is a much bigger range, and it took time. 28th of October to 13th of November, almost a month. So you wait for. So once it has happened, you wait for market to come to the premium zone, give your confirmation, and then it sells from there. All right. If it is for sell, SBR. If it is for buy, RBS on 4 hour time frame. Very, very important. And that's the third condition. The fourth condition is you want a clearly defined range. You want this is a range, a clearly defined range that has a high, the low, and the equilibrium. Right? You want a clearly defined range so that you know where the premium, if it is for buy, you know where the discount zone is, where you should wait, you should enter your trade from with confirmation. And if it is for sell, you know where the premium zone is. So it's only when you mark the range, because of course this market has been moving around. So you need to mark a range somewhere. It's only when you mark the range that you know the premium zone, the discount zone, and the equilibrium. So this is and you only mark range after RBS has happened, after the full range has been formed. So these are the four conditions you need to meet. These are and then you go down to lower time frame, and then when we talk about POI, we'll talk about the conditions that must be there before you now know, okay, you need to enter your trade. All right. So that is that. So Common mistake that traders must avoid. Common mistake that traders must avoid. Number one, don't force a direction when structure is unclear. When structure is not clear, do not force a direction. When structure is not clear, do not force a direction. Wait for structure to be clear. Wait for structure to be clear. Wait for market to give you exactly what you're looking for. When structure is clear, everything will be clear. Market, for example, right now, a lot of market is ranging due to the war in Iran, and the structure is not clear on some pairs. Wait for structure to be clear. Otherwise, if you enter inside in a ranging market, you will hit SL. The second thing is marking a range before RBS or SBR has been confirmed. Don't mark a range on 1 hour or on 15 minutes. Mark a range on 4 hours when market has broken above the high or broken below the low and giving you RBS or SBR, and then form the full range. That's when you mark the range. All right, that is when you mark the range. And another mistake, the third mistake that traders make is treating a week as a confirmed break. Week is not a break. Body must break, market must break above or below with the body of a candle, not with a wick. Wick actually means, if it is for buy and you see a wick, it actually means that this market may sell. Instead of breaking above with the body, sweeping it. It means rejection. But breaking with a body means acceptance. When market breaks with a body, breaks above with a body, is acceptance. When market breaks, sweeps it with a wick, it is rejection. When market gives you acceptance, it means that the trend continues. But if it is a rejection, it means that the same may happen, that market may just slightly change. So don't use a wick as confirmation for break. Use the body of the candle. And the fourth mistake is using the long time frame to determine structure. Do not use 1 minute time frame to determine structure. Do not use 1 minute time frame. Use 4 hour time frame. Find out what is happening on the daily time frame. Always check what is happening on the higher time frame. And then the lower time frame is for entry. It is not to confirm direction of the market. So always know what is happening on 4 hours, on the daily time frame, on the weekly time frame, on the monthly time frame, because they determine where the market moves. And the fifth and final mistake that traders make, changing your structural bias in the middle of the trade. You have confirmed the bias, you've followed your rules, you've entered, and then market is coming back to your entry, and you are afraid, and then you now want probably you want to buy and now you want to sell, and then you enter the sell, market hits your SL and eventually buys and hits your TP. Right, this is why you need to backtest, this is why you need to study, this is why you need to live trade. If you don't have money, you can use a demo account or a cent account, so that you build your conviction, so that you build your confidence. All right, you don't allow your setup to play out. You don't change structure, you don't change your bias in the middle of the trade. Once the structure is confirmed on the 4 hour and you've entered the trade, do not change your bias because 15 minutes chart moves against you. Trust your setup. All right, whatever is happening on the lower time frame is noise. It may be market pulling back to give more entries. Don't worry. If your setup is correct, then the market will move in the direction of your bias. All right. So today we learned a lot. We learned what structure is all about, how how the buy structure is formed on the chart, how the sell structure is formed on the chart, uh, long-term market structure and immediate market structure, and we also learned about what you need to see on the higher time frame before you start looking for entries on the lower time frame. We also learned the mistake that traders make, and we also talk about why trading against the structure is dangerous. Trading against structure is dangerous. It's like swimming against the current of the ocean. It's like when a car is moving forward, you want to stand in on its way, it will sweep your way. You trade with structure, and then you move. When you're trading with structure, you are trading with the big institutions, the people that move the market. And one of the things that, and we are going to talk about that, one of the things that RBS and SBR does is that you allow market to show its hand. You allow market to confirm intent, to give you the direction that is going, and then you wait for you to pick your order at the right zone, and then you move. So you move with the structure. Move with the structure. So thank you everyone that joined us. Does anybody have any question? Okay, Joshua is here. Thank you everyone that joined us. This will be on YouTube so that those who are not here will be able to learn. Thank you for joining us. Um, the next uh, the next class we are going to have is about range out of SRP, which is range. And we're going to talk about range. We're going to talk about RBS and SBI in full details, and then we are going to also, everything that has to do with liquidity and range. We're going to talk about that. Thank you for joining us. Yeah.